Welcome back. Today I'm going to be doing a video busting the myth of save $500 a month and invest it in the stock market and you'll end up a millionaire 30 years later. This video was inspired by another video that Rob Berger did, and if you watched my prior video, he had an interesting video talking about the 3-fund portfolio. I did a video that just kind of asked some questions to kind of go into the complexities of that, and while I watch a lot of his content, I'm not looking at it with an eye to criticize it, but his most recent video here also was very thought-provoking, and I wanted to make this video to kind of play out my thoughts in real time for you guys to think through it. So in this video, I'm going to be talking about how savers and investors' behaviors, your behaviors, are not linear. You don't save the same amount of money every month over a period of years. That changes. I'm going to show you a Vanguard study that confirms this. I'm also going to show you how investment returns are different if you invest monthly or in a lump sum, and how the timing of that investing behavior really matters, as well as a couple other key points here. I hope to keep this video short and sweet, and hopefully it will just be thought-provoking to you as it was to me, to help us again think through this idea of what kind of investment propaganda are we just repeating and believing because we hear it, versus looking into it and saying, how is this actually complicated? How does that complexity affect me and my behaviors? And am I doing things that are the best for me and my retirement outcomes if I act the way I'm told based on these propaganda deliveries? So stay tuned, we're going to jump right in. So right off the bat, I want to show two clips from Rob Berger's video, not picking on him again, but they're just interesting, that will lay the groundwork for the video we're about to go into. So the first here is a screenshot he did from Portfolio Visualizer that back tests a portfolio if you were to have put $10,000 into the stock market in 1972 and then just let it sit and ride all the way to 2023, how much would that be worth? So he shows this screen here where it shows an initial balance, that's the initial invested amount of $10,000. The final balance is $1,600,000 roughly, and you have a 10% rate of return over that entire time span. Now, I don't want to pick on this too much right now. I just want to point out this is what's called a cherry-picked screenshot where we do lump sum investing, and I will talk more about the challenges of this, but the flaw here is that it requires that you have that exact amount of money at the exact time you invest it, and can know ahead of time that if you just ride it out, it will have greater returns than alternatives. It also relies on the fact that you don't take distributions at any point along that route. So we'll come back to this. The second slide I want to show here is a clip he did from a Wall Street Journal article that shows something similar. If you had done a lump sum investment here of $1,000 into a 60-40 portfolio at the end of 1981, even after adjusting for inflation, that portfolio would be $18,000 by the end of 2020. Summary here is that it would have been an 18x return on that initial $1,000. So it would have 18 multiplied. So again, same idea here. There's a fallacy, which I'm going to get into more as I show some of the data about saving behavior and how investing actually works. So the question is, how does that change the calculus of these different simple models or simple examples that were being shown? I'll clip another slide here really quickly just to kind of put this up for everyone to see, which is a screenshot of a well-known finance influencer on Instagram who regularly posts these things. Again, I have no problem with the content he's sharing, but this is just emblematic of this kind of challenge, which is he'll regularly post these case studies, and you can see it here. Tom invests $500 a month over 30 years. Here are all the risks and market downturns that he faced that could have spooked him out of the market. And at the end of it, for staying put and being such a consistent guy, he ends up with this $1 million plus portfolio. And again, this is an example of flattening a complicated subject, because the question is, this isn't a real person. What would Tom's actual saving behavior really have been over that time? And the truth is, we don't know, because people are unique and individual and different, and their savings behavior will change. Now, I'm going to pull up a Vanguard study that corroborates this exact thing. So the Vanguard study here shows and says in words right here. So this comes from a Vanguard study called the 2023 How America Saves study. And Vanguard talks about all the different participants in its employer plans. And it says right here, as with plan participation rates, employee demographics have a strong influence on deferral rates. So let me translate some terms. Demographics refers to the age of the employee and how long they've been working at the company. Deferral rates refers to how much an employee decides to contribute of their income into their 401k. And so it says here, income is the primary determinant of deferral rates, which generally rise with income. That means employees defer more of their income as they make more money. In 2022, participants with incomes of less than $30,000 had deferral rates of 4.7 to 5.5%, which means they save a smaller percent proportionally of their income when they make less money. And then while participants earning $75,000 to 100,000 had deferral rates of 8.2%. So not only do they make more money, they also save more, and you can see that continues here. A savings rate 2/3 higher, and then the deferral rate was 9.2%, or the highest in this example, for participants earning between $100,000 and $150,000. Okay, that's income tied to how much we save. So obviously, as we make more, we save more. And now income is usually tied to age. You make less when you're earlier in your career, you make more as you age in your career. So this idea, again, of a flat level savings rate of $500 a month just doesn't make a lot of sense, as with many things. It's just kind of not believable when you think about it critically. The second part here is age is another important variable influencing saving. The deferral rate was lowest for participants younger than 25, which was at 5.2% of income, and then participants age 55 to 64 deferred nearly twice as much, averaging 8.7% of income. Again, this just reinforces and confirms that same thing. You make less when you're younger, and when you're younger, you save less. You make more when you're older, and when you're older, you save more. And what this ultimately translates to is that the bulk and best parts of your saving and investing years will be skewed towards later in your saving life, typically sometime after your mid-40s for most people. Now, this is borne out in the Vanguard literature, and if you want to see the actual chart here, I have it up on the screen. I'll make it available in the description below that shows what changes happen to people's savings behavior based on how long they work, et cetera, et cetera. There's two more quick points I'd like to make to kind of round this video up. Again, I don't have answers. I will think about the answers and make videos addressing some of these things, but I'm just pointing out the complexities that arise when we look at things like simple statements like invest this much, become a millionaire. So we've already talked about nonlinear savings behavior. We've already talked about how it's skewed based on income and age. Well, there's two other key points here. The third key point is that distributions and when you need access to that money really matters. Now, I won't go deep into that because my last video talks about how sequence of returns, but also distributions will affect investor behavior and what the right investment portfolio should be for you. The simple summary of that is just how does our idea of investment stability or consistency in the investments we select change when we also need to start taking money out of the portfolio, and that money out needs to be compensated for by an increase in rate of return or a different strategic plan. So it's just another element of complexity that needs to be thought about. And then my final point here is about compounding. So we're told this whole premise of this, put $500 in, do it on a flat linear level every month for this many years and you'll end up this big of a millionaire, is based on the premise of compounding. That if you start early, you put the money in and the investments compound over time, that you will have this it starts out small and linear and that it becomes exponential and gets faster and faster, the growth of your money. The issue here is that investments don't compound in the stock market, because with the investment, for it to compound, you need to have a principal floor where your money can never go below, and the form of payment that comes, or the compounding form, has to be in the form of interest, which is payment for your investment. Investments in the stock market perform based on, for the most part, capital appreciation or price fluctuation, which means you buy something for a low price and hope that you can sell it at a much later point for a high price. This does not equate to compounding, because the problem is that price can go down over time, and you might invest at low points on the price scale or high points on the price scale. It confuses the idea of compounding in a way that influences us to make decisions where we think we're getting compound interest when we're not. Now, the investments can compound. It just is more complicated than just saying, hey, this compounds at all points over time. You could have years where you have negative returns, or even months where you have negative returns. I can do a more complicated model and show it on the screen at a future point, but I just wanted to point out that, again, these ideas of investment gospel, of investment propaganda, I call it, that we just take at face value, lead us to make decisions that might not be in our best interest. There's more complexity to this than is admitted, and my hope in making these videos is simply to stimulate your thoughts. I'm not trying to convince anyone to my way of thinking. I'm not trying to grow a YouTube channel and become an influencer. I'm trying to educate, and I hope that these videos communicate that goal, which is this is complicated, and I'm not going to mislead you by giving you simple answers to complicated problems. The answer to complicated problems is it takes time, it takes effort, energy, and education. So I hope I'm communicating that effectively in these videos. I hope you enjoyed these videos. And again, I'm always happy to talk about these subjects. If you have comments or criticisms about my own lens through which I viewed it, I'm happy to address them in a video, or even have a dialogue or a debate to talk through some of this stuff, because I just seek to understand it better myself. I don't want to be married to any one idea and make mistakes. So thank you for your time and attention. I hope you enjoyed the video. As always, please like this video if you liked it. It lets me know to make more videos on this subject. Please subscribe to my YouTube channel if you'd like to see more videos like this. You can share this video and the other investment videos I've done with anybody who you think might benefit from it. And as always, if you're interested to learn more about me and my fiduciary fee-only financial planning practice, you can visit my website at www.thepeakfp.com. You can schedule a free consultation there to learn more about what it's like to work with us and how we might think through some of this stuff as it relates to you specifically. Thanks for your time and attention, and see you in the next video.